All right, welcome back to the channel. It's been a little bit, things have been busy, and we got a lot to talk about, so let's get right to it. We're looking at the S&P 500. We're seeing a little bit of a pullback, but again, see where we've come from, right? We've come a long way. And so this week was a lot of red on the market, a handful of green. Um, and we had a lot of earnings this week, so the market's just kind of digesting a lot of news coming in. So a lot of stocks are having a little bit of a pullback, which is not the end of the world. This is a healthy thing that we're looking at, um, and this is the S&P 500. I wouldn't be surprised if we had another at least 3%, maybe more. And that's healthy to continue this long-term trend of going up, coming out of this bear market we had last year. That would be a good thing. So the market is digesting earnings from different companies. We saw a lot last week. We had Amazon, we had Apple, um, AMD, and Tesla was the week before. And all these companies are doing well. They're doing well. Some more than others. Like Amazon killed it. Amazon just what a phenomenal, crazy business Amazon is. The more I dig into Amazon, the more I'm just blown away at how many businesses they have. Um, I mean, 134 billion dollars in a quarter for revenue. I mean, that's pretty wild. Um, so, anyways, I'm not going to dive too deep on all of these. And then you saw, a company like Apple report their earnings, and they dropped hard. So, Amazon popped 8%, and Apple went down almost 5%, which is a huge move for Apple, being that they're a $3 trillion company. Well, not anymore, 2.86. So they lost almost $300 billion this week, came out of Apple stock. So, um, again, earnings weren't terrible, but I think the market is starting to digest and say, okay, a lot of stocks have moved a long ways. Do the numbers match the move that the stock price has made, right? So Apple has gone from 125 almost to 200. Has their earnings justified that move or not? So now the market is trying to find equilibrium, right? Are the numbers matching up with the rise in the stock price? And you're going to see some stocks say no and some stocks say yes, depending on their performance quarter to quarter. So we still got more earnings to go. Next week we've got nothing too crazy. Disney is the big one. I'm sure there's going to be some other ones, some healthcare companies, Eli Lilly. So we'll keep an eye out for those. But so far, so good with earnings. There hasn't been anything that's been like, oh my gosh, the market's going back to a bear market. I'm more and more constructive on the market. I do really want to see a nice little dip to really be more aggressive. So, companies like PayPal, they're getting hammered again on their earnings. But their earnings to me looked really good. There were some things that were somewhat concerning, but at the same time, long term, I don't think it's going to hurt the business. User growth is going down, so they're not getting as many users as they used to, but the users that they have are sticking, and they're spending more money on the platform. So to me, that's law of large numbers, right? As you grow, it's harder to grow at that continuous rate. But as long as you're retaining and your current customers are paying more, that's good. That means they like your service and they're using it more. And so that's kind of what's going on there with PayPal. And then another stock we talk about a lot here is Enphase. They had their earnings, and I know we've talked about it. Solar is very tied to interest rates, and so they did meet expectations on their earnings, EPS per share, earnings per share, but their guidance was really low. So they're guiding for a down quarter. 613 million is what their estimate is, which is less than their 720 this past quarter. So again, tied to interest rates, most likely. They had to write down some inventory issues. So long term, really like the company. There's a lot of bad companies in the solar industry, and this is one of the really good ones. And Tesla had their earnings as well. I thought they did really well. Um, so 24 billion in the quarter, doing real well. Long term, phenomenal. So long term, things look really good. Short term, we could continue to see a little bit of a pullback, but that's a good thing unless you just retired yesterday. If you just got your last paycheck and you're depending on selling all your stocks to finance your retirement, you don't want to pull back. But if you are not retired yet, you want to pull back because everyone is a forced buyer, whether you're buying in your 401k or you're investing in a Roth IRA or you're a trader, whatever it is, you want the market to go down so you want to buy things cheap, and stocks are no different. So, um, anyways, look to see a little bit more of a pullback, and then, like we've talked about, I think that's a good time to take advantage. But we're just getting started. Don't go all in right now. So let there be a little bit more pain in the streets. And the other big news that we had this week was the credit, Fitch, the company called Fitch, a credit rating company. So there's S&P, there's Moody's, and then there's Fitch. Those are the three large rating agencies out there. So they determine, or they put grades on, hey, this company or this country, they have AAA rate, so their debt is very good. Feel safe owning their debt. Or hey, this is Venezuela. They have poor stability, so we're going to downgrade their credit. So, anyways, Fitch downgraded the United States from AAA to AA plus. It's really not that big of a deal, but it's just the shock value is really what's more important. And what it's doing to the yields is interesting because it's causing yields to go higher, even though yesterday we saw a little bit of a pullback in yields. But this week we saw a big jump in the 10-year yield. And, part of that could be people selling bonds because bond prices are inverted. If people sell bonds, the yield needs to go up. Also, the U.S. is issuing a lot of debt. So they're to finance all of our spending, they have to get that money somewhere. And this is one way that they're doing it, by issuing a lot of bonds. And if the buyers don't match up for the amount of bonds being issued, the yield goes up to entice more buyers, right? So if I were to tell you, hey, if you give me 100 million, I'll give you 1%, not a lot of people are going to do that. But if I say, hey, you give me 100 million, I'll give you 10%, more people will give me their money because they want that higher yield. So that's what's happening here. We're financing a lot of our spending by issuing more U.S. debt, and there may not be as large of an appetite for that. And also some people may be selling some of their bonds. So we're seeing rates go up and the bond market being super volatile. So who knows where rates end up topping out? We'll just have to wait and see. But it is something to keep an eye on and be and see what's happening. Mortgage rates hit a 23-year high this week also, so that's something to pay attention to. So my thoughts real quick on all this. It is, you could be, you're either in the camp of I don't care, I don't worry about it, or oh my God, the U.S. is going to end, put your money in Chinese dollars or Bitcoin or whatever. So to me, the downgrade it doesn't matter. To me, it doesn't matter. It's something to be aware of and how it's going to affect the markets. You're going to see more volatility because of that. But long term, what is the alternative is my question here. So yes, you can downgrade, but just because someone downgraded, does that mean I'm going to get rid of all my dollars and go buy the Chinese yuan? Or am I going to go buy a what do I have up there? Zimbabwe note, $1 billion Zimbabwe note. So they're really, am I going to buy pesos? There's not an alternative currency out there yet. So I don't know what that's going to be. the U.S. still has the strongest economy. We have the best businesses. We have a bunch of terrible politicians, but I still believe in our system. We got a bunch of old people in there now, but I still believe in the system. So I'm not throwing away my dollars yet. Yes, there's going to be inflation and there's going to be purchasing power being devalued, but that's always been the case. And that's, if we have it bad here, everywhere else has it worse, I guess is a good way to put it. So that's my thoughts on the whole Fitch downgrade. Something to pay attention to, but I'm not losing sleep over this. And yeah, it would be great if our politicians could work together and stop pointing the fingers at one another. This is your fault. This is your fault. We're gonna do the debt ceiling whenever that pops up. We're gonna do it at the last second to make everyone bite their nails. It would be much better if we could just be more efficient and less clown show like. So that's all I got to say on that. But it is creating some volatility in the market, and the timing of it's pretty interesting too, because it almost seems like you could have downgraded a long time ago. You could have downgraded all through the pandemic when that money printer was just cranking. You could have downgraded during the debt ceiling. You could have downgraded during the banking crisis, and then also when we bailed out the banks and cranked that printer again. But they did it right now when the market's a little vulnerable and it's almost kind of like, hey, you're close to the edge of the stairs, boom, push it down. So I don't know. That's a little tinfoil hat conspiracy theory. But that's my thoughts on the downgrade. And let's move on here. So let's look at the bull and bear case. Really not too much change here. Inflation, it is going down. Things are still stupid expensive. We've got interest rates, volatile. But again, I think they're closer to done to hiking in the hiking cycle than at the beginning. So that's good. The banks, the credit crunch, and commercial real estate, no change there. There was a change here, the narrow breadth and the rich valuations. We are seeing energy do better. We're seeing some commodities do better. And we're seeing some of the tech valuations either come down or their earnings are justifying that increase in price. So that's not as crazy bad as it looked earlier this year. The yield curve inversion, let's look at that. Because of the bond because the bond market volatility, the inversion is starting to uninvert. And as we've talked about, when the yield curve uninverts, that's when we need to really be on alert of recession, right? I'm not going to go through that again. We've talked about that a bunch of times, but we're seeing a sharp spike here like we saw in March. The question is, do we continue uninverting or do we go back down or what? So we're keeping an eye there. Again, we're looking at the yield curve to see when are we going to uninvert, because we're deeply inverted 10-year chart. And once we get past zero, once we uninvert, that's when the recession hits short after that. So we'll have to wait and see. Let's see here. Earnings haven't bottomed. I have that in yellow because there are some parts that look really good and some parts where it's like, ooh, solar looks like it may be going through its rolling recession now. So it seems like each sector over the last year or so, post-COVID, has gone through a rolling recession, right? During COVID, energy got hit. Shoes did well, right? And then post-COVID, energy went high, shoes got hit, right? So that's just an example where it hasn't been a recession where everything goes down at once. It's like, hey, you take your turn. If you're in energy, you go down, but then, shop at home's going to go up. So things have been rotating. It's been a rolling recession where it's almost like sectors take their turn. Like, hey, you take the hit and I'll skyrocket, and then vice versa. So earnings haven't bottomed as yellow because some are doing really well. Some are like, they're kind of hitting, they're still going down. They haven't troughed and made their way back up. Bull case long term, a couple new things on here. cloud computing growth just looks unbelievable. And then also the electrification of the world. Those are two things I'm just super bullish on. You want to find exposure to whatever companies are going to keep stoking this. I got here an Amazon AWS chart. So, this is the cool part of Amazon, right? They make a lot of money. And most of it is from their cloud computing, AWS. So here's a chart of AWS revenue growth over the years. And it's just, it's just killing it. And when you think about it, that's not going to slow down. It's going to slow down because of the law of large numbers, but I expect that trend to keep going. And when you look at Microsoft's earnings, Azure's doing really well. That's their cloud. Google Cloud's doing really well. Oracle, their cloud is doing really well. I don't think we've seen their earnings quite yet, but I would expect their cloud to continue to be growing as well. And so whatever components feed into that, semiconductors, right? Those feed into the cloud. You need data centers, and you need to upgrade your hardware to continue to stoke this growth. And so the other part was electrification of the world. Um, you know, Obviously Tesla, the easy part is the cars, but also just all the infrastructure around it. So, solar is going through a tough time right now, but long term, I really think the solar and the batteries is going to be such a huge part of just the grid and just everyday life. So, this is also something I highly recommend everyone go watch. And this is cool because this is local. I see these trucks all the time because I'm here just outside of Sacramento, and this Pepsi plant is in Sacramento, and they have 21 Tesla semi trucks. Some of them are for long haul, and some of them are for shorter trips. But it is pretty neat to see all the changes that they're doing. They also have other companies that they're working with. But, again, I don't think this is going to save all the whales. I just think this is a very neat, and to me, the electrification part makes a lot of sense. I am so glad I don't have to go to a gas station anymore. I just got a charger installed into the side of my house. So every night I come home and I just plug my car in and I wake up with a full tank, and it costs me a couple dollars to charge. So to me, that just makes a lot of sense. I don't want to pay 50, 60 bucks at the pump when I can pay a couple dollars at home. So, so that's bull case. I see those things continuing to do really well, and they continue to blow my mind at where we're headed. So those are things that I'm definitely very bullish on, and I think we're definitely heading in the right direction. This is a long video, so if you're still here, I appreciate you. And some opportunities, some action items. This is old, Tesla next week. But opportunities we're looking out for, these haven't really changed. I still like healthcare. Long term valuations are good. It's a ignored space right now, in my opinion. I really do like REITs, but you need to know what you own. I've talked about those in previous videos. Bonds, the yields just skyrocketed again, so you could also lock in some longer term bonds now and get a good yield. And then this is green, right? We've got the buyable dips for tech. Give it a little bit more time, in my opinion, not financial advice. But we're starting to see the trend break a little bit. And August, September, and October are typically the weaker months in the market. I don't know why, but it just seems to be where the market kind of has dog days. These are the dog days of summer and of the market, and it does provide some good opportunities to load up on your best stocks while maybe funds are rotating their positions. So always avoid FOMO. Don't go put a bunch of money into Amazon, even though they're killing it. Wait for a pullback. Just wait for a pullback. Or dollar cost average in. Just don't go blow your wad because you don't chase green candles. No FOMO. Small caps. I'm going to take this one off. You got to, small caps are like REITs. You really need to know what you own. I don't want to buy a basket of small caps because there's a lot of garbage in the small caps. And also with rates going higher and staying higher, it's hard for some of these small cap companies to finance their operations if they're not profitable. So I'm going to take that one off for now. Focus on those, in my opinion, and earnings. Earnings are still going. Palantir's on Monday. I'll be watching that. Um, and, that's about all I got for you guys today. Again, longer video. I appreciate everyone watching. Go get some sun. I got to say, things do look much better. I just went to Monterey at the beautiful Spanish Bay, and I was blown away at how many people are out there traveling. We drove down I-5, and it was packed. You pull off to a gas station on one of the rest stops, and there's 5, 6 gas stations. You couldn't even find a pump. You couldn't find a parking spot. Every Tesla charger station was full to the max. People are out spending money. I don't know where people are getting all this money to spend. They must have been long Nvidia, but good for them. I'm glad. So anyways, things are looking better every day, in my opinion. But just wait for a nice buyable dip on your favorite stocks. Again, I'm liking PayPal. I'm liking Enphase. I'm loving Tesla. I'm loving Amazon. But I want to get them at the right price and buy them with a margin of safety for long-term gains. So anyways, that's all I got for you guys. Super long video. Appreciate you guys, and peace out.